Now, lesson 15, balance of trade. Now, a country's balance of trade is the economic value of all the products that it exports minus the economic value of its imported products. Now, a positive balance of trade is when a country exports more than it imports, and a negative balance of trade is when a country exports less than it imports. So the US has a negative balance of trade because the US imports more than it exports. Now, a negative balance of trade indicates that more money is being taken out of the economy, as there are more imports than exports. So this means less money is available for investments that can increase production. Now, every month the US balance of trade operates at a deficit of approximately negative $44 billion. So this is bad for the US. And this is because higher monthly deficit means less money in the economy to fund investments that can increase employment in the economy and productivity in the economy. So a high deficit is bad for a country and bad for that country's currency. Okay, now when the deficit decreases from month to month, that is positive for the currency, as that means less money is leaving the economy. And if less money is leaving the economy, this means there are more money in the economy to fund production and to fund productivity. So a high monthly deficit is bad. So whenever we see a decrease in the monthly deficit, this is positive for the US dollar and positive for the US economy. Now in the next lecture we'll be looking at ticks.